So why the rush to taper? And why are markets taking it in stride? David Zervos joins me this afternoon with more. He is Jefferies' chief market strategist. David, what's your read on this hawkish rhetoric?
Well, I don't think there was much surprising with Jim or with Esther. You had two, noted hawks or folks who have been, pushing a rather aggressive stance. I think the market was eagerly awaiting Rob Kaplan's comments, especially after what happened last Friday, because he's actually been probably one of the most hawkish and a steadfast hawk at that for quite some time. And he seemed to waver on Friday, and now he walked it back a little bit. So I think, I think the market's probably a little bit confused by Rob, and maybe we'll get some more clarification as time goes on. But I imagine, right now the sort of steadfast hawkishness that we had believed was part of the Kaplan world may not be so steadfast. And even if he walks it back, people are still going to feel that he's not 100% there just yet, given what happened last Friday. So I think that's where the market is. That's why it's not taking it so badly, because all three of these presidents, really nothing new was said. I mean, you kind of knew where they stood. What we're waiting for is Jay tomorrow, and I think a little bit more clarity on the data. Frankly, that's the most important thing. But I don't think you got a lot of new information on hawkishness today.
If Kaplan was wavering at all, or if the Fed decides to kind of push this back a couple of months, would Delta be the reason?
I think it's part of it, but I think we were also questioning how quick this recovery was going to be, and I think there were a number of people on the committee, even in the minutes, that said, "Hey, we might have to develop a contingency plan for delaying asset purchases for some time." So there were certainly doves on the committee, whether that's Jay or not, it probably is. Whether it's Lael Brainerd, probably is. There may be a few others. I think it's. I think there's a pretty wide stratification on the committee as to how quickly you need to go. And even Rob said today, he's not advocating what Jim was advocating, which is being done by the first quarter. He was talking about 8 months or 9 months of tapering. So I think the whole thing is much more nebulous at this stage. And a lot of it is the data. And frankly, Kelly, one thing, we had some pretty weak data so far in August. Hard for me to see a big August payroll print on September 3rd, next Friday, when we had, a fair amount of weak data in the last 2 or 3 weeks, whether it's the Empire, the Philly, the retail sales, the core CPI came back down, and obviously the University of Michigan data, which we talked about the last time also.
Yeah, it seems like that payroll number is going to be the event of the next few weeks here. Do you buy this argument that seems to make the rounds every time they're tapering, that tapering is not tightening? And I don't know if they're making explicitly that case right now, but they seem to be in a hurry to say, well, the taper's not the same as raising interest rates. But do markets take it as they're both tightening of financial conditions?
They're both the removal of accommodation. So in that sense, it's a tightening. I don't think there's any question about that, no matter how you want to slice it. So yes, it's a tightening. It's a removal of accommodation. This is an accommodative stance. And if you take some away, you've removed some of it. How the balance sheet interacts, this is the really interesting part is how are they going to market the balance sheet? Because the last time they reduced the balance sheet, they used these words autopilot and tried to just push it on the side. And that backfired spectacularly in 2018. And they had to kind of deal with the financial market repercussions from removing the balance sheet or reducing the balance sheet too quickly. And I think autopilot will never be uttered again in public by a Federal Reserve president or governor or chair or vice chair. I think of the process of balance sheet reduction / tapering, if they even do reduce, let's just go to taper first. I think it will be a dynamic process, not a static process, not something that's announced and left for dead. It's something that will be revisited each meeting, and how big it is and how fast it is and how it goes will be debated each time.
Let me ask you about just kind of the market outcomes. So you stay long the S&P 500 here. I know we've talked all year about the need to hedge that because of the confidence in policymakers to get this right. We know we have a deluge of corporate bond issuance coming. A lot of people see this as kind of a whole daisy chain where they're issuing debt, they are buying back shares. There's tons of people participating in this rally. Does this market outcome for you still point towards continued gains, continued rally, and trust in the Fed to kind of read the signals one way or the other and get this timing right from the bull's point of view?
I think so. I don't place a lot of stock in the views that were espoused today by Jim and Esther in terms of guiding the committee. I think they're on the fringe of the hawkish side. I think Rob made a little bit of a change. Whether he's backtracked or not remains debatable. But I think, clearly he's not as hawkish as he was based on what happened last Friday. So I think you're going to see more tempered response from the central bank going into the end of the year. I think they're going to want to watch the data. You've got a lot of changes in the makeup of the central bank. Randy Quarles' job is up in October. Rich Clarita's job is up in January. Jay's job is up in February. It's a time for transition. It's a time where you could confuse the market. I just don't see the reason to get too crazy. And as we've talked about before, Kelly, we're missing nearly 6 million jobs from where we were in February 2020, and real GDP has been flat for 6 quarters. We haven't grown since Q4 of 2019. What's the rush? The rush is only that you believe inflation is going to run rampantly above where you want it to. And the fact is, for a decade, it was running rampantly below where you wanted it to. And we've taken back about 5 years of those misses, but we still have a decade-long miss that is pretty significant. And depending on what their window is on the look back for the average inflation targeting, they've got some room to play with here.
I'm going to put that's your new hat, is what's the rush. Dave, thanks for joining me today to talk through all of these scenarios. Really appreciate it, your point of view. David Zervos of Jefferies.
Shepard Smith here. Thanks for watching CNBC on YouTube.